There is a document, published once a year, that contains the master key to nearly every great fortune built in the last century. It is the single most important tool for anyone serious about building wealth, a direct line into the mind of the world's most successful business leaders. And yet, for 99% of people, it might as well be written in a dead language. They either ignore it completely, intimidated by its density, or they open it and immediately get lost, drowning in a sea of numbers and corporate jargon, focusing on all the wrong things. They treat it like a report card on the past, a dusty artifact. They miss the secret. This document is not a report card. It is a blueprint for the future. It's called the Annual Report, or the 10K, and the 1% who know how to read it don't just see numbers, they see a story. They see strategy. They see weakness. They see the deep underlying reality of a business. And no one in history has mastered the art of reading this story better than Warren Buffett. He has a specific, systematic method for cutting through the noise, for extracting the vital intelligence from this document in under an hour. A method that has made him one of the wealthiest people on the planet. This is not about complex financial modeling or having a degree in accounting. This is about a fundamental shift in mindset. It's about learning to read an annual report not as a stock picker, but as a potential business owner. Today, we are going to deconstruct that entire system. We will give you the exact mental framework Buffett uses, a step-by-step process for turning this intimidating document into your most powerful weapon for building wealth. You will learn what to read, what to skim, and what to ignore completely. This is the antidote to information overload. This is the skill that separates the amateur from the professional, the speculator from the business analyst. Master this, and you will unlock a level of financial literacy and insight that the vast majority of market participants will never, ever possess. Our journey into the heart of Buffett's method for financial statement analysis begins not with a number, but with a mindset. It's the foundational pillar upon which his entire value investing philosophy is built. He calls it the owner's mindset. This is the radical idea that you should never read an annual report as if you are analyzing a stock. You must read it as if you are considering buying the entire business outright, with all your family's money, and holding it for the next 30 years. This single shift in perspective changes everything. It transforms the document from a confusing collection of tables and charts into a deeply personal conversation. Suddenly, the most important section isn't the income statement or the balance sheet. It's the very first thing most investors skip, the shareholder letter. For Buffett, this letter is not a public relations formality, it is a job interview. He is interviewing the CEO and the management team to see if they are the kind of people he wants as his business partners. He is testing them for two crucial traits, candor and rationality. Are they honest about their mistakes? And are they intelligent in how they allocate the company's capital? This initial qualitative assessment is the gatekeeper. If the management fails this test, Buffett closes the report and moves on, no matter how cheap the stock looks. The numbers can't be trusted if the people reporting them can't be. This principle of treating the shareholder letter as a sacred text of managerial character is the first and most critical step in his due diligence process. To truly understand the power of this owner's mindset, we must travel back to one of the most chaotic and fear-drenched moments in modern financial history, the Great Salad Oil Scandal of 1963. The story revolves around a company called Allied Crude Vegetable Oil, run by a man named Tino DeAngelis. DeAngelis had devised a brilliant, fraudulent scheme. He would take out massive loans using his inventory of salad oil as collateral. The only problem was, most of the salad oil didn't exist. His tanks were mostly filled with water, with a thin layer of oil floating on top to fool the inspectors. When the fraud was discovered, Allied Crude collapsed, defaulting on over $175 million in loans, an astronomical sum at the time. The shockwave ripped through Wall Street, and one of the hardest-hit companies was American Express. Why? Because a subsidiary of American Express had been the one issuing warehouse receipts guaranteeing that Tino DeAngelis' salad oil was real. Suddenly, American Express was on the hook for the entire fraud. Panic erupted. The market assumed Amex was insolvent, that the liabilities would wipe out the company. The stock price was annihilated, plummeting nearly 50% in a matter of weeks. Wall Street analysts, financial journalists, and the entire investing public saw only one thing: a catastrophic liability. They saw a number on a balance sheet and ran for the exits. This was the path of the 99%. But Warren Buffett, then a young, relatively unknown fund manager in Omaha, Nebraska, saw something different. He didn't start with the balance sheet. He started with the business itself. He activated the owner's mindset. He asked a simple question: if I owned all of American Express, what would my real business be? He knew the answer wasn't warehousing salad oil. The real business was the brand, the trust, the ecosystem of travelers' checks and credit cards. So, he did something no Wall Street analyst would ever do. He left his office. He went to restaurants in Omaha. He went to banks. He stood in line and watched people. He talked to cashiers and hotel clerks. He asked them, "Are you still accepting American Express cards? Are people still buying travelers' checks?" The answer, overwhelmingly, was yes. People were angry at the company's management for the mistake, but their fundamental behavior hadn't changed. The brand, the economic moat, was intact. Customers still trusted the core product. Having confirmed the health of the underlying business, he then turned to the annual reports from the years before its the scandal. He wasn't looking for clues about the fraud. He was reading the shareholder letters from the CEO, Howard L. Clark. He was trying to understand the character of the man at the helm. He saw a management team that, while having made a colossal error with their warehousing division, was fundamentally rational and focused on their core, high-return businesses. He concluded that the management, faced with this crisis, would act honorably and intelligently to protect the franchise. Only then did he do the final math. He determined that even if American Express had to pay every single dollar of the salad oil claims, the company's powerful earnings from its credit card and travelers' check businesses would allow it to survive and thrive. The market was pricing in ruin. Buffett's business analysis priced in a severe but survivable wound to an otherwise phenomenal company. He famously invested 40% of his partnership's capital into American Express stock, a bet that would become one of the foundational legends of his career. It was a masterclass in reading the situation, not just the numbers, and it all started by ignoring the panic and reading the annual report like a business owner, beginning with the character of the management and the nature of the enterprise. The psychological principle that Buffett masterfully navigates here is known as the principal-agent problem. In economics and corporate governance, this is the inherent conflict of interest that arises when one party, the agent, in this case the CEO and management, is hired to act in the best interests of another party, the principal, the shareholders. The problem is that the agent's personal interests, a bigger salary, a larger empire, fame, prestige, may not perfectly align with the principal's interest, which is maximizing long-term per-share value. A CEO might pursue a flashy, overpriced acquisition because it makes headlines and grows the company's revenue, even if it destroys shareholder value by being unprofitable. This is where the shareholder letter becomes a powerful psychological diagnostic tool. Buffett is using it to screen for agency risk. A CEO who writes in clear, simple language, admits mistakes, and focuses on business metrics rather than stock price is signaling that they view themselves as a steward of the principal's capital. They are behaving like a partner. Conversely, a CEO who uses dense jargon, blames external factors for failures, and brags excessively about the stock's performance is waving a giant red flag. They're behaving like a hired hand trying to impress a boss, not a partner in a shared enterprise. Buffett is also overcoming a powerful cognitive bias known as the halo effect. This is our tendency to let one positive trait of a person or company color our judgment of their other traits. A charismatic, visionary CEO who gives great interviews on television can create a powerful halo. Investors become so enamored with the leader's personality that they fail to critically examine the company's actual performance or strategy. They assume that because the CEO is impressive, the business must be too. Buffett's method pierces this halo. He doesn't care about charisma, he cares about candor. The single greatest test of candor is the admission of a mistake. When a CEO writes in the annual report, "Last year we made a significant error in judgment by acquiring company X. We overpaid, and it has not performed as expected. This was my mistake, and here is what we learned from it." They are sending an incredibly powerful signal. It signals honesty, accountability, and a commitment to reality. It shows they are not trying to spin a narrative for the market, but are instead focused on the long-term health of the business. This act of admitting failure short-circuits the halo effect and allows for a clear-eyed assessment of the business, a crucial step in any serious equity research. The 99% get seduced by the story. Buffett insists on auditing the storyteller first. So how can you, as an investor, translate this powerful concept into a practical, repeatable process? You can use a mental model we'll call the CEO Candor Test. This is a 5-step blueprint for reading any shareholder letter to determine if management are the kind of partners you want for your capital. It's a crucial tool for your stock market education. Step 1. Read the first paragraph and then read the last. A great CEO, writing to his business partners, will get straight to the point. The first paragraph should give you a concise, no-nonsense summary of the year's performance, both the good and the bad. The last paragraph should be a clear-eyed look at the challenges and opportunities ahead. If the letter begins with fluffy PR speak, marketing slogans, or self-congratulatory nonsense, it's a warning sign. They are selling, not reporting. Step 2. Perform the pronoun test. As you read the letter, pay close attention to the pronouns used. Do the managers say we and our? For example, in 2023, our profits declined because of a mistake we made in pricing. This language signals psychological ownership. They see themselves as part of the business. If the letter is filled with phrases like "the company achieved" or "the business unit saw growth," it can signal a subtle but important detachment. This is the language of a bureaucrat, not an owner. Step 3. Hunt for the mistake. This is the most important step. Carefully read the entire letter, specifically looking for an admission of failure. Every business, no matter how great, makes mistakes over the course of a year. A new product launch might fail, an acquisition might underperform, or a strategic initiative might not pan out. A candid CEO will own these mistakes, explain what happened, what they learned, and how they will prevent it from happening again. If you read an entire letter and there is no mention of any error, misstep, or disappointment, you should be deeply skeptical. It's a sign of either arrogance or dishonesty. Great management is not about being perfect, it's about being relentlessly honest about imperfection. Step 4. Apply the clarity versus jargon filter. Is the letter written in plain, simple English that any intelligent person can understand? Or is it littered with corporate buzzwords like synergy, leveraging core competencies, right-sizing, and optimizing paradigms? Jargon is a tool of obfuscation. It's used to make simple ideas sound profound or to hide a lack of clear thinking. As Buffett says, we would rather be approximately right than precisely wrong. A CEO who can't explain their business in simple terms either doesn't understand it well enough or is trying to hide something. Step 5, and this is the killer step. Compare promises to results. This requires a little more work, but it provides the ultimate validation. Pull up the annual report from the previous year, read the shareholder letter, and identify the specific goals, plans, and promises the CEO made for the coming year. Now, go back to this year's letter. Did they do what they said they were going to do? Did they report on the results of the initiatives they promised to undertake? This simple act of checking the receipts separates the talkers from the doers. Management that consistently delivers on its stated goals is a management team you can trust. By running every shareholder letter through this 5-step process, You transform it from a passive reading exercise into an active due diligence investigation, establishing a firm foundation for any further fundamental analysis. The path of the 99% is paved with the exact opposite of this disciplined, owner-centric approach. The average investor, if they read the shareholder letter at all, treats it as a piece of marketing material. They fall for the very psychological traps that Buffett's method is designed to avoid. They get seduced by the charismatic CEO, the grand vision, the exciting new technologies mentioned in the letter. They see buzzwords like artificial intelligence, digital transformation, or blockchain integration, and mistake them for a real business strategy. Their analysis stops at the surface level. They don't dig deeper to ask, how specifically will this technology improve our per-share earnings power? They allow the halo effect to take over, assuming that a company working on exciting things must be a good investment. Furthermore, the 99% completely misuse the letter by focusing on the stock price. Many shareholder letters begin with a chart showing the company's stock performance versus the S&P 500. The average investor sees a line going up and to the right and gets a jolt of social proof and FOMO, the fear of missing out. They think, wow, this stock is a winner, I need to get in on this. They fail to understand a crucial distinction that is at the heart of value investing. The stock is not the business. A rising stock price can be driven by market mania and have no connection to the underlying improvement in the business's intrinsic value. Buffett is reading the letter to understand the business. The 99% are reading it to get clues about where the stock price might go next week. This leads to a catastrophic failure in executive decision-making on a personal level. They also fail the candor test spectacularly. Instead of searching for mistakes, they are drawn to relentless optimism. A CEO who pounds the table and promises record-breaking growth and disruptive innovation is seen as a strong leader. The investor who buys into this narrative is engaging in confirmation bias. They want to believe in the exciting story, so they accept the CEO's promises at face value without any skepticism. The idea of pulling up last year's report to check on old promises would never even occur to them. This creates a dangerous feedback loop, where overpromising, under-delivering CEOs are rewarded with high stock prices from undisciplined investors, at least until the inevitable day reality sets in and the story falls apart, taking the stock and the investors' capital down with it. The direct financial connection between this first pillar and building wealth is profound and tangible. It all comes down to one of the most important concepts in all of finance: capital allocation. A CEO has 5 basic options for the cash a company generates: reinvest it back into the business, acquire another business, pay down debt, issue a dividend, or buy back stock. The long-term financial success of any company is almost entirely determined by the wisdom with which its management team makes these 5 decisions, year after year. A candid, rational CEO, the kind you identify with the candor test, will approach these decisions like a true business owner. They will only reinvest in the business if the potential returns on that investment are high. They will only make acquisitions at reasonable prices. They will buy back stock only when it is trading below its intrinsic value. These are the actions that create real, long-term per-share value. A promotional CEO, on the other hand, will destroy capital. They'll chase growth for the sake of growth, pouring money into low-return projects. They'll overpay for a flashy acquisition to get on the cover of a magazine. They'll buy back stock at record-high prices to prop up the stock and trigger their own bonus payments. This is how shareholder wealth is systematically destroyed. This difference in capital allocation skill shows up directly on the financial statements. A company with excellent capital allocators will consistently show a high and stable return on invested capital, or ROIC. This metric tells you how much profit the company generates for every dollar of capital put into the business. It is the ultimate report card on the CEO's decision-making. By using the shareholder letter to find honest and rational partners, you are dramatically increasing your odds of investing alongside management that will intelligently compound your capital for years to come. You are avoiding the capital destroyers. This single, qualitative check, performed before you even look at a single number, is arguably the most important risk management tool an investor has. It prevents you from getting into business with the wrong people, and as in life, that is the first step toward achieving financial freedom. Once you have identified a management team that passes the owner's mindset test, a team you'd be happy to have as your partners, the next crucial pillar of the Buffett method is to determine if the business they are running is actually a good business. Not all businesses are created equal. Some are locked in a brutal hand-to-hand combat for survival, where competition is fierce, customers are disloyal, and profits are fleeting. Others are like fortresses, protected by a deep, sustainable competitive advantage that allows them to earn high profits year after year with minimal threat from competitors. Buffett famously calls this competitive advantage an economic moat. Just as a moat protects a castle from invaders, an economic moat protects a business from competition. This is the second and arguably most important thing Buffett is looking for when he reads an annual report. He is searching for evidence of a durable moat. He wants to understand the source of the company's power. Is it a beloved brand name that commands customer loyalty and pricing power? Is it a patent that locks out competitors? Is it a network effect, where the service becomes more valuable as more people use it? Or is it a low-cost advantage that allows the company to consistently undercut its rivals? Identifying this moat is not a simple numbers game. It requires a deep, qualitative business analysis. Buffett pores over the business description, the management's discussion and analysis, or MD&A, and the competitive landscape sections of the 10K report to piece together the story of the company's competitive position. A business with a wide and sustainable moat is a business that can compound capital at a high rate for a very long time. It is the true source of all great long-term investment returns. The perfect foundational anecdote to illustrate the search for the economic moat is the story of one of Buffett's most beloved and successful investments, See's Candies. In 1972, Charlie Munger brought the deal to Buffett. On the surface, it looked like a terrible investment according to the value investing principles of Buffett's mentor Ben Graham. See's was not a cigar butt, a statistically cheap, unloved stock. The asking price from the See family was $25 million. At the time, the company had only $8 million in tangible assets and was earning about $2 million a year after tax. A $25 million price tag for a business with only $8 million in assets seemed absurd to the Buffett of that era, who was trained to buy things for less than they were physically worth. The numbers on the balance sheet screamed, overpriced. This is where the 99% would have stopped their analysis. They would have seen a high price-to-book ratio and immediately discarded the idea. But Buffett and Munger decided to do a deeper business analysis. They started reading the company's history and its reports. They weren't just looking at the financials, they were trying to understand the business. What they discovered was a story that the numbers alone could not tell. See's Candies, particularly in California, was more than just a chocolate company. It was an institution. For decades, customers had been giving boxes of See's for birthdays, Valentine's Day, and Christmas. The act of giving and receiving a box of See's was tied to powerful emotions of love, celebration, and nostalgia. This emotional connection created a formidable economic moat built on an intangible asset, its brand. This brand gave See's incredible pricing power. Buffett realized that customers were not particularly price-sensitive. If a man was buying a box of chocolates for his girlfriend for Valentine's Day, he wasn't going to risk switching to a cheaper, unknown brand to save $1 or $2. The emotional cost of a bad gift far outweighed the small financial savings. This meant that See's could raise its prices every year, year after year, without losing significant business. The price increases would drop straight to the bottom line, generating ever-increasing profits without requiring much additional capital. It was a cash-generating machine. Buffett and Munger recognized that the true value of See's was not the $8 million in tangible assets, the factories and the stores. The true value was the brand that existed in the minds of millions of customers. This intangible asset was worth far more, but it didn't show up on the balance sheet. They paid the $25 million. Over the years, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital investment. It was a monumental success that fundamentally changed Buffett's approach to investing. It taught him that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The See's Candy story is the ultimate example of looking past the surface-level financials to find the qualitative economic moat that is the true source of a company's value. It was a masterclass in stock research that focused on the business, not the spreadsheet. The underlying psychological principle that explains the power of an economic moat, like the one See's Candies possesses, is a combination of brand association and the cognitive shortcut known as the availability heuristic. Brand association is the mental link consumers form between a brand and a specific set of attributes, emotions, or ideas. For See's, the brand is associated with quality, tradition, nostalgia, and affection. When a customer thinks about buying a gift of chocolate, the See's brand immediately comes to mind not just as a product, but as a reliable and socially accepted emotional signal. This mental shortcut saves the consumer the cognitive effort of researching and comparing every other chocolate brand. They don't have to think. They just know that See's is a good, safe choice. This is incredibly powerful. It creates what Buffett calls a share of mind, which is even more valuable than a share of market. This psychological lock-in is the essence of a brand-based moat. It makes customer behavior predictable and resistant to price competition. Competitors can offer cheaper chocolate, but they cannot easily replicate the decades of positive emotional experiences associated with the See's brand. This is a fortress that is nearly impossible to assail. The second principle at play, particularly in how investors perceive moats, is the availability heuristic. This is a mental shortcut where we overestimate the importance of information that is easily available to us. In the investing world, the stories of fast-growing, exciting technology companies are constantly in the news. They are highly available. This leads many investors to believe that the path to building wealth is to find the next big thing in a trendy industry. They pour their time and energy into analyzing companies in crowded, hyper-competitive sectors, because that's what everyone is talking about. In contrast, boring, durable businesses like See's Candies or trash collection companies, or companies that make industrial lubricants, are not in the headlines. Their stories are not readily available. Because of this, most investors overlook them. They fail to do the due diligence on these quiet compounders. Buffett's genius is in his ability to consciously override the availability heuristic. He deliberately searches for businesses that are simple, understandable, and often downright boring, because he knows that these are often the industries where the moats are widest and the competition is least intense. He lets the business's durable competitive advantage, not its media profile, guide his investment tools and decisions. To systematize this search for a moat, you can use a mental model called the Moat Detection Checklist. This is a 5-step guide for scanning the business description and the management discussion and analysis (MD&A) sections of a 10K report to find concrete evidence of a durable competitive advantage. This is the core of true fundamental analysis. Step 1. Identify the source of the moat. As you read, you are a detective looking for one of 5 primary sources of competitive advantage. Is it an intangible asset, like the brand name of Coca-Cola or the patents of a pharmaceutical company? Is it a network effect, where the product becomes more valuable as more people use it, like Facebook, where the Visa payment network? Is it a high switching cost, where it would be too expensive or inconvenient for customers to change providers, like the software used by a bank or an architect? Is it a cost advantage, where the company can produce its goods or services cheaper than anyone else, like Costco or Geico? Or is it a government-granted advantage, like a license for a utility or a specific piece of spectrum for a telecom company? Your first job is to form a hypothesis about what kind of moat, if any, the business has. Step 2. Look for evidence of pricing power. This is the litmus test for a strong moat. A company with a real competitive advantage can raise prices year after year without losing customers to competitors. In the MD&A section, management is required to discuss the factors that affected their financial results. Look for language about price increases. Do they talk about realizing higher prices or the impact of price adjustments? If they do, and if their sales volumes remained stable or grew, you have found powerful evidence of a moat. If the discussion is all about cutting costs to stay competitive, the moat is likely weak or non-existent. Step 3. Analyze customer concentration. In the risks section of the 10K, companies must disclose if they have any single customer that accounts for more than 10% of their revenue. This is a critical piece of intelligence. If a company relies on one or two giant customers for a huge portion of its sales, it has very little power. Those customers can dictate prices and terms, squeezing the company's profits. A true fortress business has a highly fragmented customer base, with no single customer having significant leverage. Step 4. Examine the discussion of competition. How does management talk about its rivals? Are they in a highly competitive, fragmented, and price-sensitive industry? That's a red flag. Or do they describe themselves as a leader in a consolidated industry with significant barriers to entry? That's the language of a moat. Look for the names of competitors. Are there dozens or just 2 or 3 rational players? Fewer competitors often means a more profitable industry structure. Step 5. Trace the company's history. Read the business section to understand how long the company has been around and how long it has dominated its industry. Has it been the market leader for 10, 20, or even 50 years? A long track record of leadership is strong evidence that the moat is not a temporary phenomenon but a deep, structural advantage. A company that has successfully fended off competitors for decades is likely to continue doing so. By using this checklist, you move beyond vague ideas about good companies and start identifying the specific, tangible evidence of a durable competitive advantage, a critical step in your stock market education. The antithesis to this disciplined search for a moat is the path followed by the 99%. They chase growth stories without any regard for their durability. The average investor is captivated by revenue growth. They see a company whose sales are increasing by 50 or 100% a year, and they get incredibly excited. They equate rapid growth with a great business, and by extension, a great investment. This is a catastrophic mistake. Growth is only valuable if it is profitable and sustainable. Many companies can grow their revenue very quickly by simply spending huge amounts of money on marketing or by cutting prices to unsustainable levels. This is common in story stock industries, like many of the companies during the dot-com bubble of the late 1990s. Companies like Pets.com or Webvan were growing their revenues at a breathtaking pace. Investors, caught up in the narrative of the new economy, poured billions of dollars into them. They read the exciting parts of the annual reports about market opportunity and revenue growth, but they failed to apply the moat detection checklist. They failed to ask the critical questions. What is this company's competitive advantage? Is there a barrier to entry? Pets.com had no real moat. Anyone could sell pet supplies online. The competition was brutal and based entirely on price. They had no pricing power. In fact, they were losing money on every sale, hoping to make it up on volume. This is the definition of a broken business model. Investors who chased the growth story without first confirming the existence of a moat were ultimately wiped out when these companies inevitably ran out of cash and went bankrupt. This behavior is driven by a deep-seated fear of missing out, or FOMO. When a new industry or technology captures the public's imagination, a speculative frenzy can take hold. Investors suspend their critical thinking and buy stocks simply because they are going up and are associated with a compelling story. They mistake a popular trend for a durable business advantage. Buffett's disciplined focus on finding a moat first is the perfect antidote to this destructive emotional impulse. It forces you to be a business analyst, not a storyteller or a trend follower. The direct financial connection between finding a business with a wide economic moat and building wealth is stark and undeniable. It manifests most clearly on the income statement in the form of high and stable gross margins. Gross margin is calculated as revenue, cost of goods sold / revenue. It tells you what percentage of every dollar in sales the company keeps after paying for the direct costs of producing its product or service. A company with a strong moat, particularly one based on a brand or a patent, does not have to compete on price. It can charge a premium for its products. This leads to high gross margins. For example, a commodity business like a steel manufacturer might have gross margins of 10 or 15%. They are in a constant struggle with competitors, and price is the only weapon. In contrast, a company like Moody's, the credit rating agency with a powerful duopolistic moat, can have gross margins of over 70%. That incredible profitability is a direct financial result of its competitive advantage. Furthermore, a strong moat leads to consistent and high returns on equity, or ROE, without the use of excessive debt. ROE measures how effectively a company uses shareholder money to generate profits. Businesses in highly competitive industries often have to use a lot of leverage, debt, to magnify their otherwise mediocre returns. A business with a moat can generate high returns organically. This financial strength gives the company immense flexibility. It can fund its own growth without needing to borrow money or sell more stock. It can return huge amounts of cash to shareholders through dividends and buybacks. Over the long term, it is this ability to consistently generate high returns on capital, protected by a deep economic moat, that creates the compounding effect that builds massive fortunes. When you find a business with this characteristic, you have found not just a good stock but a true wealth generation machine. The moat is the ultimate financial asset, even if it never appears on the balance sheet. Having confirmed that we are in business with honest and rational partners, Pillar 1, and that the business itself is a fortress protected by a durable economic moat, Pillar 2, we now arrive at the third pillar of Buffett's analysis, the profitability test. This is where we finally dive into the financial statements, but not in the way most people do. We are not here to get lost in 100 different line items. We are on a targeted mission. Our goal is to use the numbers to confirm the story we've already uncovered. If the company truly has a great moat, that superiority should be visible in its financial performance. But we must be careful. The headline number that 99% of investors focus on, the reported net income or earnings per share, EPS, can be misleading. It is an accountant's opinion, subject to a wide range of assumptions and potential manipulations. Buffett looks deeper. He is interested in uncovering the true, underlying earnings power of the business. He wants to know how much cold, hard cash a business owner could theoretically take out of the business at the end of the year, while still maintaining its competitive position. He has a specific concept for this, which he calls owner earnings. This is the key metric he uses to test a company's profitability. It's about cutting through the accounting fog to find the economic reality. This focus on the real, cash-based profitability of a business is what separates a value investing professional from an amateur who simply looks at the surface-level EPS. A fantastic story that demonstrates Buffett's obsession with a company's true earnings power is his landmark investment in the Washington Post Company in the early 1970s. At the time, the stock market was in a slump, and newspaper stocks were particularly hated. Investors saw them as old media dinosaurs. The Washington Post stock had fallen so far that the entire company was valued by the market at around $80 million. Buffett, having just come through the Watergate era, recognized the incredible power and prestige of the Washington Post newspaper. He saw it as a local monopoly in Washington, D.C., an essential institution for the nation's most powerful people. He identified the economic moat immediately. But the real genius of his analysis came when he dug into the financials to assess its profitability. On the surface, according to the reported GAAP, generally accepted accounting principles, net income, the company looked only modestly profitable. The price-to-earnings ratio was not extraordinarily cheap. This is where most security analysis would have stopped. But Buffett knew that for a business like a newspaper, the reported earnings were deeply misleading. The biggest expense distorting the picture was depreciation. GAAP accounting requires a company to deduct a non-cash charge for depreciation every year to account for the gradual wearing out of its assets, like its printing presses. For the Washington Post, this depreciation charge was a very large number, which significantly reduced its reported net income. Buffett, however, asked a crucial business owner's question. How much money does the Post actually have to spend each year on new printing presses and equipment to maintain its dominant position? He dug into the cash flow statements and historical capital expenditure records. He discovered that the actual cash spending on capital expenditures, or CapEx, was far, far less than the non-cash depreciation charge. The printing presses were lasting much longer and required less investment than the accounting rules assumed. This meant the company's true profitability, its ability to gush cash, was much higher than what was being reported on the income statement. He was performing his owner earnings calculation. He took the reported net income, added back the huge non-cash depreciation charge, and then subtracted only the small amount of actual cash CapEx the business needed. The result was a number, the true owner earnings, that was vastly larger than the reported net income. He realized that at a market price of $80 million, he could buy this media fortress with its unassailable moat for what amounted to just a few times its real cash-generating power. He invested aggressively, buying over $10 million worth of stock for Berkshire Hathaway. The investment was a staggering success, compounding in value for decades and becoming one of the cornerstones of Berkshire's wealth. It was a victory made possible only by his refusal to accept the headline profitability number and his insistence on digging deeper to find the true economic engine of the business. The psychological principle that Buffett masterfully circumvents with his focus on owner earnings is called anchoring bias. This is our cognitive tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. In investing, the most common anchor is the reported earnings per share (EPS) number. It's the headline figure in every quarterly earnings report, the number that Wall Street analysts build their models around, the metric that flashes across the screen on financial news networks. Because it is so prominent, investors anchor their entire valuation of a company to this single, often flawed number. They see a company with an EPS of $5 and a stock price of $50, and they immediately think, okay, it's a 10 PE stock. Their analysis is now anchored to that 10 PE multiple, and all subsequent information is viewed through that lens. Buffett's concept of owner earnings is a deliberate act of de-anchoring. He is consciously choosing to ignore the first number presented and calculate his own, more accurate measure of profitability. This gives him a massive intellectual and competitive advantage. While everyone else is arguing about whether a stock is cheap or expensive based on a flawed anchor, Buffett is operating with a different set of coordinates based on economic reality. He is also fighting against a second related bias, confirmation bias. This is the tendency to search for, interpret, and favor information that confirms one's pre-existing beliefs. An investor who likes a company's story will see a record profit headline and take it as confirmation that their thesis is correct. They will stop digging. They won't bother to open the cash flow statement to see if that profit is actually being converted into cash. They won't question the quality of the earnings. They will see the information that confirms their desire to buy the stock and screen out anything that might contradict it. Buffett's process is the opposite. It is a process of systematic skepticism. He assumes the reported number might be wrong and actively seeks to disprove it by comparing it to the cash reality. This intellectual rigor, this willingness to do the extra work to get to the truth, is a hallmark of his approach and a key reason for his long-term success in building wealth. To apply this principle to your own investing, you need a blueprint. Let's call it the owner earnings calculation, a 5-step mental model for getting a more accurate picture of a company's profitability than its reported net income. This is a powerful investment tool for any serious student of fundamental analysis. Step 1. Start with net income. You'll find this at the very bottom of the income statement. This is our baseline, the official accounting profit. Step 2. Add back all non-cash charges. The most common and largest of these are depreciation and amortization, D&A. You'll find these on the cash flow statement, in the cash flow from operations section. These are not real cash expenses. They are accounting conventions. We add them back to the net income to get a clearer picture of the cash the business is actually generating. Step 3. This is the most important and nuanced step. You must now subtract the average annual amount of capital expenditures, or CapEx, that the business needs to spend to maintain its operations and competitive position for the long term. This is often called maintenance CapEx. You can find the total CapEx figure on the cash flow statement under cash flow from investing. The key here is not to just use last year's number, as it can fluctuate wildly. A better approach is to look at the last 5 or 7 years of CapEx and calculate an average. For some businesses, the total CapEx is a good proxy for maintenance CapEx. For others that are in a high growth phase, you might need to make a conservative estimate. The goal is to figure out how much the company has to reinvest each year just to stay in the same place. Step 4. Adjust for changes in working capital. Also, in the cash flow from operations section, you'll see a line item for changes in working capital. If this number is consistently negative, it means the business requires more and more cash to be tied up in inventory and receivables as it grows. This is a real cash drain, and you should subtract this from your owner earnings calculation. Conversely, some great businesses, like those with subscription models, have negative working capital and actually generate cash as they grow. Step 5. The number you are left with is a conservative estimate of owner earnings. Net income plus D&A, maintenance CapEx, plus or minus changes in working capital. This is the unlevered free cash flow that belongs to the owners of the business. This is the number you should be using for valuation purposes. It represents the real, distributable cash profit of the enterprise. Comparing this owner earnings number to the company's market capitalization will give you a much more accurate sense of whether a business is truly cheap or expensive than a simple P/E ratio ever could. The antithesis of this rigorous approach to profitability is where the 99% of investors live, and unfortunately where they often lose money. The average investor has a dangerous fixation on the headline earnings per share (EPS) number. Their entire analytical process begins and ends with this single metric and its derivative, the price-to-earnings (P/E ratio). They hear on the news that a company beat earnings expectations by a penny, and they rush to buy the stock without any understanding of the quality of those earnings. They fail to ask the most important question: is this profit real? They never make the crucial trip over to the cash flow statement to see if the reported earnings are being backed up by actual cash generation. This is a common trap in investing for beginners. A company can report rising net income for years while actually having negative cash flow. This can happen if, for example, they are selling products on credit to customers who are slow to pay. The income statement records a sale and a profit, but the cash hasn't arrived yet. A business that doesn't generate cash will eventually die, no matter what its income statement says. The 99% also completely ignore the capital required to generate profits. They see two companies, each earning $1 million, and they assume they are equally good businesses. But what if Company A generated that $1 million of profit from an asset base of only $2 million, a 50% return on capital, while Company B needed $100 million of assets and factories to generate its $1 million of profit, a 1% return on capital? Company A is a spectacular business. Company B is a terrible one. The P/E ratio tells you nothing about this crucial difference. By focusing only on the income statement, these investors are flying with only one instrument, and it's often the least reliable one in the cockpit. They end up buying capital-intensive, low-return businesses that look cheap on a P/E basis but are actually classic value traps, destined to earn poor returns for their shareholders over the long run. The direct financial connection between focusing on owner earnings and your personal financial success is immediate and powerful. It all comes down to valuation and capital returns. A business that is cheap on the basis of its owner earnings is genuinely a bargain. When you buy a company for, say, 5 times its owner earnings, you are getting an owner earnings yield of 20%. This means that for every dollar you invest, the business is generating 20 cents of real, distributable cash profit per year. This is the true return you are getting on your investment in the business. This massive cash generation gives a company incredible financial firepower and flexibility, which benefits you directly as a shareholder. First, a company with strong owner earnings can easily pay a growing dividend without taking on debt. This provides a direct cash return to you. Second, it can aggressively buy back its own shares. When a company buys back its stock, it reduces the total number of shares outstanding, which makes your individual shares more valuable and increases your percentage ownership of the business. Third, and most importantly, it can reinvest that cash into high-return growth projects, creating a powerful compounding effect that drives the intrinsic value of the business and eventually its stock price higher over time. A company that looks profitable on a GAAP basis but has weak or negative owner earnings can do none of these things. It is a financial mirage. It may have to take on debt or sell more stock just to keep the lights on, diluting your ownership and destroying value. By making the owner earnings calculation the centerpiece of your profitability analysis, you ensure that you are investing in real, cash-generating businesses. You are buying the economic engines that will fund your journey to financial freedom, not the ones that just look good on paper. This is the quantitative heart of value investing. We have now established a three-part foundation for our analysis. We've found honest management, a business with a protective moat, and confirmed its true profitability with owner earnings. But even a wonderful, profitable business run by great people can be a terrible investment if it's financially fragile. This brings us to the fourth pillar of Warren Buffett's method, the financial health check. Before he will even consider investing, Buffett conducts a thorough examination of the company's balance sheet. He is looking for a business that is built to last, one that can not only survive but thrive during the inevitable recessions and periods of economic turmoil. His primary focus is on debt. Buffett has a deep, almost allergic aversion to excessive leverage. He knows that debt is the single most common killer of otherwise good businesses. A company with a mountain of debt is a company that has given up its financial flexibility. It is beholden to its bankers, and its strategic decisions are often dictated by the need to make interest payments rather than the long-term health of the business. In his one-hour scan of an annual report, Buffett dedicates significant time to a few key areas of the balance sheet and the related footnotes to ensure that the company he is considering is a financial fortress, not a house of cards. This due diligence on the company's financial health is a non-negotiable step in his process, a critical risk management protocol designed to obey his first rule of investing: never lose money. The quintessential anecdote that reveals Buffett's deep-seated skepticism of financial fragility is his famous, decades-long aversion to the entire airline industry. For most of his career, Buffett publicly and colorfully condemned airlines as a terrible business. His most famous quote on the subject is a masterpiece of dark humor. If a far-sighted capitalist had been at Kitty Hawk, he would have done his successors a huge favor by shooting Orville down. His reasoning was a perfect illustration of the fourth pillar. When he performed his financial health check on the airlines, they failed on every conceivable level. First, they were incredibly capital-intensive. To grow, or even just to maintain their fleet, they had to spend billions of dollars on new airplanes. This is the opposite of the capital-light businesses he loves. Second, this immense capital requirement forced them to take on staggering amounts of debt. Their balance sheets were, and still are, loaded with long-term liabilities. This made them extraordinarily fragile. A small dip in travel demand due to a recession, a spike in fuel prices, or a global event could quickly push them to the brink of bankruptcy, as their massive, fixed interest and lease payments came due regardless of their revenues. Third, they faced powerful unions, which meant high and inflexible labor costs. This combination of high capital needs, high debt, and high fixed costs was, in Buffett's view, a recipe for financial disaster. He saw an industry that, over its entire history, had consumed far more capital than it had ever returned to shareholders. The path of the 99% was to get excited about airlines during economic booms, when travel was strong and profits were temporarily high. They would look at the low PE ratios and think they were getting a bargain. Buffett, by contrast, was reading the balance sheet and the long-term history, recognizing the inherent financial weakness that would inevitably be exposed in the next downturn. His discipline in avoiding this entire industry for decades despite periodic bouts of investor enthusiasm is a testament to his unwavering focus on balance sheet strength. It demonstrates that for him, avoiding a potential catastrophe is far more important than chasing a potential cyclical gain. The financial health check is his primary tool for steering clear of the corporate graveyards. The psychological principles that Buffett uses his financial health check to defend against are recency bias and its close cousin, optimism bias. Recency bias is our natural human tendency to give too much weight to our recent experiences when we forecast the future. During long periods of economic expansion, like the one that lasted for much of the 2010s, investors forget what a real recession feels like. They see years of stable growth, low interest rates, and rising profits. This recent experience becomes their baseline for the future. As a result, they become complacent about risk, particularly the risk of debt. They see a company with a lot of leverage and think, well, they've been handling it just fine for the past 5 years, so it must be safe. They fail to consider how that same balance sheet would look in a world with higher interest rates and falling revenues. Optimism bias is our tendency to believe that we are less likely to experience a negative event than others. Investors infected with this bias believe that the companies they own are somehow immune to the business cycle. They acknowledge that recessions can happen, but they have an irrational confidence that it won't seriously harm their body portfolio. This leads them to overlook the flashing red lights of a weak balance sheet. They see high debt-to-equity ratios and rationalize them away, believing in the company's growth story or the brilliance of its management. Warren Buffett, having invested through more than a dozen recessions and market panics over his long career, has had the benefits of recency and optimism bias brutally beaten out of him by experience. He operates with a healthy dose of paranoia. He always assumes that a period of severe economic stress could be just around the corner. This mindset forces him to prioritize financial strength above all else. His balance sheet analysis is not an academic exercise. It is a survival plan. He is stress testing the business to see if it can withstand the storm that he knows, sooner or later, will arrive. This disciplined, experience-based skepticism is the perfect antidote to the market's often dangerous, short-sighted optimism. To put this pillar into practice, you can use a powerful mental model called the 5-minute balance sheet stress test. This is a quick yet highly effective checklist to assess a company's financial health, a core component of any serious equity research. You can perform this entire check in just a few minutes, and it will help you avoid 90% of the potential blow-ups in the market. Step 1. Check the debt-to-equity ratio. This is a classic, simple metric. You take the company's total liabilities and divide them by its shareholders' equity. You'll find these numbers on the balance sheet. For most non-financial companies, you want this ratio to be below 1.0, and ideally below 0.5. A low number indicates that the company is financed more by its owners, capital, than by creditors, money, which is a sign of conservatism and strength. Step 2. Check the current ratio. This measures the company's ability to pay its short-term bills. You calculate it by dividing current assets by current liabilities, both found on the balance sheet. A ratio comfortably above 1.5 or even 2.0 is a good sign. It means the company has more than enough liquid assets to cover all of its obligations that are due within the next year. A ratio below 1.0 is a major red flag. Step 3. Analyze the debt paydown history. This requires a bit of historical perspective. Pull up the annual reports from the last 5 or 10 years. Look at the line item for long-term debt on the balance sheet. What is the trend? Is the debt level steadily decreasing or staying flat? This shows a management team that is disciplined and focused on strengthening the company. Or is the long-term debt constantly increasing year after year? This could be a sign that the company isn't generating enough internal cash to fund its operations and is relying on borrowing to survive. Step 4. Perform the goodwill check. Goodwill is an intangible asset that gets created on the balance sheet when one company acquires another for a price higher than the value of its tangible assets. Look at the asset side of the balance sheet. Is a huge percentage of the company's total assets made up of goodwill? If so, it tells you that the company's growth has come primarily from making acquisitions, not from organic expansion. This can be risky, as history shows that most large acquisitions fail to create value for the acquiring shareholders. A company that has grown organically will have very little goodwill. Step 5. Read the footnotes on debt. This is where the real details are. In the footnotes to the financial statements, there will be a section detailing the company's debt. Scan this section for two key pieces of information: the interest rates on the debt and the maturity schedule. Are the interest rates low and fixed, or are they variable and at risk of rising? Is the debt due far in the future, or is there a huge maturity wall where a large amount of debt needs to be refinanced in the next year or two? This quick stress test will give you an incredible amount of information about the financial resilience of a business. The path of the 99% is a stark and dangerous contrast. The average investor focuses almost exclusively on the income statement and largely ignores the balance sheet. The income statement tells a story of profit and growth, which is exciting and easy to understand. The balance sheet tells a story of assets and liabilities, of strength and fragility, which can seem boring and complex. This is a fatal error in financial literacy. They get swept up in the narrative of a high-flying growth stock, impressed by its soaring revenues, without ever stopping to check how that growth is being financed. They buy companies that are funding their aggressive expansion with mountains of debt. In good times, this leverage can amplify returns and make them look like geniuses, but they fail to realize they are sitting on a financial time bomb. When the economic cycle inevitably turns, when interest rates rise or a recession hits, these are the companies that get obliterated. Their revenues fall, but their interest payments do not. They are forced into survival mode, cutting research and development, laying off talented employees, and selling assets at fire sale prices. In the worst cases, they are forced into bankruptcy, and the common shareholders are completely wiped out. The 99% see debt as a tool for growth and a sign of ambition. Buffett sees debt as a source of potential ruin and a claim on future earnings that belongs to the bankers, not to him. By ignoring the balance sheet, the average investor is essentially agreeing to be the last one to get paid and the first one to get wiped out in a crisis. They are taking on immense, uncompensated risk without even realizing it. The direct financial connection between a strong balance sheet and building wealth is arguably the most powerful in all of investing, particularly over the long term. First, there's the obvious impact on the income statement. A company with little to no debt has very low interest expense. This means that more of its operating profit flows directly down to the bottom line, boosting net income and owner earnings. This is money that belongs to you, the shareholder, instead of being paid out to the bank. But the more profound financial advantage is strategic. A strong balance sheet creates what is known as optionality. During a severe recession or a market crash, a company with a lot of debt is playing defense. It is in survival mode. But a company with a pristine balance sheet, perhaps even with a net cash position, can play offense. This is when fortunes are truly made. That company can use its financial strength to buy back its own stock at deeply depressed prices, dramatically increasing the long-term value for the remaining shareholders. It can acquire its financially weaker competitors for pennies on the dollar, consolidating its market leadership. It can invest in new products and marketing while its rivals are cutting back, allowing it to steal market share that it will keep for years to come. In short, a recession, which is a catastrophe for a weak company, is a massive opportunity for a strong one. By insisting on a fortress-like balance sheet, you are not just protecting yourself from losses on the downside. You are positioning yourself to achieve extraordinary gains on the upside when others are panicking. This is how multi-generational wealth is built, by surviving the bad times and aggressively capitalizing on them. Your commitment to financial health check is your ticket to being on the right side of that equation. We have now journeyed through 4 of the essential pillars of the Buffett method. We've learned to adopt an owner's mindset, to hunt for an economic moat, to verify true profitability, and to stress test for financial health. This alone puts you ahead of the vast majority of market participants. But there is one final pillar, and it may be the most important of all in today's world of overwhelming information. This is the pillar that saves you time, protects you from disastrous mistakes, and keeps you focused on what truly matters. It is the fifth pillar, the art of intelligent ignorance. A crucial part of Buffett's genius is not what he does, but what he consciously chooses not to do. He has an incredible filter for separating signal from noise. When he opens a 10K report, he is not trying to read and understand every single word, footnote, and number. He knows that most of it is irrelevant at best and actively misleading at worst. He has a short, specific list of things he is looking for, and he has a much longer list of things he deliberately and systematically ignores. This is his antidote to the investor's greatest enemy: information overload. In a world where we are bombarded with data, analyst ratings, and complex financial metrics, the ability to know what to ignore is a superpower. This final pillar is about developing that superpower, about creating your own too-hard pile, and about focusing your limited time and mental energy only on the things that will actually contribute to your success in building wealth. The ultimate foundational anecdote for the art of intelligent ignorance is the dramatic collapse of long-term capital management, or LTCM, in 1998. LTCM was a hedge fund that was, on paper, the most brilliant financial institution ever created. Its partners included Myron Scholes and Robert C. Merton, who had just won the Nobel Prize in economics for their work on options pricing. It was staffed with PhDs in mathematics and physics from the world's top universities. They created incredibly complex quantitative models to exploit tiny pricing discrepancies in global bond markets. Their annual reports were hundreds of pages long, filled with Greek letters, advanced calculus, and financial jargon that was incomprehensible to almost everyone. For a few years, the fund generated spectacular returns, and its partners were hailed as the new masters of the universe. Then, in 1998, following a Russian debt default, their models broke. The tiny risks they thought they had hedged away all correlated at once, and the fund began to lose hundreds of millions of dollars a day. It was leveraged over 100 to 1, and its collapse threatened to take down the entire global financial system. The Federal Reserve had to orchestrate a massive, multi-billion-dollar bailout from a consortium of Wall Street banks. And who was one of the first people the bailout consortium called for help? Warren Buffett. They offered him a chance to take a leading role in the rescue and own a piece of this legendary fund for a fraction of its former value. Buffett famously took a look at their financial statements, a document that was probably 280 pages long. After a short review, he declined to participate. His reason was simple and profound. He told the other bankers, "I can't understand it." He, a man renowned for his financial acumen, looked at the work of Nobel laureates and admitted that he had no idea what the real risks were. The models were too complex. The derivatives were too opaque. He couldn't get his mind around the business. So he put it in what he calls his too-hard pile. This is the physical manifestation of intelligent ignorance. Buffett has a mental and literal pile for businesses and investments that are simply too complicated for him to understand with a high degree of confidence. It doesn't matter how smart the people involved are or how much money they seem to be making. If he can't explain in simple terms how the business works and what the key risks are, he passes. The 99%, in contrast, often feel a need to have an opinion on everything. They are intimidated by complexity and assume it must be a sign of sophistication. They saw the Nobel Prizes at LTCM and thought, these guys must know what they're doing. Buffett's humility, his willingness to say, I don't know, is one of the most powerful risk management tools he possesses. It saved him from the LTCM debacle and countless others like it. The psychological principles behind Buffett's too-hard pile are the antidotes to two very dangerous cognitive biases: expert worship and the Dunning-Kruger effect. Expert worship is our tendency to blindly trust the pronouncements of people who have impressive credentials or hold positions of authority. The partners at LTCM were the ultimate experts, Nobel Prize winners, legendary traders. This created a powerful halo effect that caused most people, including many sophisticated bankers, to suspend their own critical judgment. They outsourced their thinking to the experts. Buffett, while respecting intellectual horsepower, has a deep-seated belief that in investing, you must do your own thinking. He will not invest in something just because a smart person told him to. His refusal to invest in LTCM was a rejection of expert worship. He trusted his own principle of understanding over their credentials. The second bias is the Dunning-Kruger effect. This is a cognitive bias whereby people with low ability at a task overestimate their ability. In investing, this is rampant. A novice investor who has had a bit of luck in a bull market can quickly become overconfident. They start to believe they are a genius and wade into complex areas they don't understand, like options trading, cryptocurrency, or highly speculative biotech stocks. They don't know what they don't know. Buffett's concept of the circle of competence is the perfect defense against the Dunning-Kruger effect. He has spent a lifetime clearly defining the boundaries of what he knows and what he doesn't know. He knows a great deal about insurance, consumer brands, and banking. He knows very little about cutting-edge software or pharmaceutical research. He is disciplined about staying within his circle. He doesn't let his success in one area create overconfidence that leads him to speculate in another. This conscious, humble admission of the limits of his own knowledge is what keeps him safe. The art of intelligent ignorance is not about being uninformed. It's about being profoundly aware of the difference between what you know with certainty and what you are merely guessing about. So how can you build this discipline of intelligent ignorance into your own investment process? You can start with a mental model we'll call the Investor's Ignore list. This is a list of 5 specific things that you will train yourself to deliberately skip or discount when you are analyzing a company's annual report. This will save you countless hours and prevent you from being misled. First on the list, ignore EBITDA. This stands for earnings before interest, taxes, depreciation, and amortization. It is a metric beloved by Wall Street analysts and private equity firms because it makes companies look more profitable than they really are. Charlie Munger has famously said that EBITDA should be a 4-letter word. Why? Because interest and taxes are very real cash expenses. And the idea that depreciation and amortization are not real costs is, as Buffett says, a myth. The D and the A, the capital expenditures needed to maintain a business, are the silent killers. To pretend they don't exist is financial fantasy. Ignore EBITDA and focus on owner earnings. Second, ignore adjusted or pro forma earnings. In their press releases, and sometimes in their annual reports, companies will present an adjusted EPS number. This is their way of saying, here's what our earnings would have been if you ignore all the bad stuff that happened this year, like restructuring charges or asset write-downs. This is pure marketing. Always focus on the official GAAP earnings as your starting point, and then do your own analysis to get to the real owner earnings. Third, ignore the stock price chart. Many annual reports contain a chart showing the company's stock performance over the past 5 years. This is completely irrelevant to your analysis of the business. The past performance of the stock has zero predictive power about its future performance. Looking at this chart will only anchor you to past prices and pollute your objective analysis of the business's intrinsic value. The report is about the business, not the squiggly line. Fourth, ignore overly complex footnotes. The footnotes are where companies are required to disclose important details. But if you encounter a section on derivatives, special purpose entities, or pension accounting that is so dense and jargon-filled that you cannot understand it after a reasonable effort, you should treat that as a red flag. It is not a failure of your intellect, it is a failure of the company's transparency. If they can't explain it clearly, it may be because they are trying to hide something, or the business is simply too complex. Put it in the too hard pile. Fifth, Ignore all Wall Street price targets and analyst ratings. These are marketing tools, not objective analysis. The job of a Wall Street analyst is often to generate trading commissions, not to provide sound, long-term investment advice. Their price targets are notoriously unreliable. Your job is to calculate the intrinsic value of the business yourself, based on your own research and analysis. Trust your own work, not theirs. The antithesis to this disciplined approach is the path of the 99% who suffer from a chronic case of intellectual FOMO, the fear of missing out on an idea. They feel a deep-seated psychological pressure to have an opinion on every hot stock and every new, disruptive technology. When a company like NVIDIA becomes the talk of the town, they feel compelled to understand it and invest in it, even if semiconductor design is far outside their circle of competence. They spend hours trying to decipher complex technical jargon and convoluted financial statements, believing that complexity is a sign of a sophisticated opportunity. They get bogged down in the minutiae. They listen to hours of conference calls, trying to parse every word from the CEO for a hidden clue. They build elaborate spreadsheets with dozens of variables, attempting to forecast earnings 10 years into the future with decimal point precision. This is what Buffett calls false precision. They mistake activity for progress. The tragic irony is that all this extra effort often leads to worse results. By trying to be an expert in everything, they become a master of nothing. They are so busy chasing every new idea that they fail to do the deep, focused work required to truly understand a handful of great businesses. This need to be involved in everything also makes them highly susceptible to narratives and stories. When a compelling new story emerges, whether it's about genomics, artificial intelligence, or clean energy, they feel they have to participate, even if the businesses themselves have no moats, no profits, and fragile balance sheets. Their desire to appear smart and informed overrides the more important goal of being rational and safe. Intelligent ignorance is the cure for this disease. It gives you permission to say, "I don't know and I don't care," to 99% of what is happening in the market, allowing you to focus all your energy on the one or two opportunities that you can understand with absolute clarity. The direct financial connection between intelligent ignorance and building wealth is the ultimate form of risk management. The greatest financial losses in an investor's career rarely come from buying a mediocre business that underperforms slightly. The catastrophic, portfolio-destroying losses almost always come from one or two major blow-ups, investments in companies that were fundamentally misunderstood. This is the risk of the unknown. When you invest in a business whose accounting is too complex, whose technology is too opaque, or whose financial instruments are beyond your comprehension, you are exposing yourself to an unknown and unquantifiable risk. You could be blindsided by a hidden liability or a fatal business flaw that you never saw coming, just as the bankers who trusted LTCM were. By rigorously adhering to your circle of competence and putting everything else in the too hard pile, you are systematically eliminating the single greatest threat to your long-term financial success, the possibility of a catastrophic error. This preserves your capital, which is the essential foundation upon which all wealth is built. Rule number 1 is never lose money, and rule number 2 is don't forget rule number 1. The art of intelligent ignorance is the most powerful tool for following those rules. It keeps you out of the situations where a total loss is a real possibility. Over an investment lifetime, the money you don't lose on bad ideas is just as important as the money you make on good ones. This disciplined practice of omission is what protects the asset side of your personal balance sheet and ensures you will be around long enough for the power of compounding to work its magic. You have just been given a powerful and complete mental framework. You've absorbed the 5 pillars that form the bedrock of Warren Buffett's method for analyzing a business. You now know how to read an annual report not as a collection of numbers, but as a living story. You can assess the character of management, identify the strength of the economic moat, calculate the true owner earnings, stress test the balance sheet for durability, and know what noise to intelligently ignore. This is not just a set of tips for reading a document. It is a fundamental upgrade to your thinking. You now possess the mental toolkit to move from being a speculator, tossed about by the whims of the market, to being a true business analyst, capable of making rational, informed decisions for the long term. You have invested your time to acquire a skill that will serve you for the rest of your life. But mastering this framework, as powerful as it is, represents the mastery of just one critical piece of a much larger puzzle. The system you've just learned is the microscope. It allows you to analyze a single company with incredible clarity and depth. However, a microscope is useless if you don't know where in the vast wilderness to point it. How do you find the handful of potentially great companies worth putting under the lens in the first place? And once you have analyzed a great business and determined its quality, how do you then determine a rational price to pay for it? And perhaps most importantly, how do you assemble a collection of these great businesses into a resilient, anti-fragile portfolio that can withstand the storms of the market and compound your wealth for decades? The analysis of one company is a vital skill, but it is the connection between that skill and the broader strategies of sourcing, valuation, and portfolio construction that completes the system. The knowledge you have just acquired is the key to a single door. The video that is now appearing on your screen is the key to the next door in the hallway. It is the missing link. It takes the principle of deep business analysis you've just mastered and connects it to the overarching architecture of a complete investment philosophy. Think of what you've learned today as learning how to perfectly forge a single, unbreakable link of a chain. The principles in the video before you now are about how to connect those links to build a chain capable of pulling you toward financial freedom. It is the next piece of the map, the component that elevates your understanding from the tactical to the strategic. The journey of building true, sustainable wealth is a process of assembling a complete arsenal of mental models. You have just added a powerful weapon to your collection. The next one is waiting. You have come this far because you are not a dabbler. You are not looking for hot stock tips or get-rich-quick schemes. You are an apprentice in the craft of rational investing. You are building an intellectual fortress. The casual viewers have already clicked away. The next click is not for entertainment. It is a conscious decision to continue your ascent, to complete your arsenal. Continue the journey.